Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to the bigger picture. Me, Ryan Huang, and we are coming off a strong week for U.S. markets, and futures are holding steady so far as we head into a critical stretch on Wall Street. So looking at a Nasdaq composite, it closed at a record high last Friday. So some momentum behind tech as we see some growing optimism around Fed policy. So all eyes on the Federal Reserve as it is widely expected to cut interest rates this week. So what is going to be in store as we look forward to Thursday morning Singapore time? And to break down what is also happening for this week, we've got Oktay Kavrak. He is the Director of Communications and Strategy at Leverage Shares. Oktay, good morning. How are you doing today?
Good morning. I'm doing great. How about yourself?
Doing great as well. And it looks like markets are doing pretty okay. Looking at what we have last week, we had record highs, but a bit of profit taking. Walk us through how markets are setting up for this week.
Yes, obviously it's going to be a very interesting week. Last week we saw all the three major, at least U.S. indices, all close out record highs, which very rarely happens. And just moving forward, it's going to be very interesting to see after the FOMC announcement what's going to happen in the short term, right? Because if we look back historically, sort of the last, I would say close to 20 times when rates were cut with the market at all-time highs, and when I say the market, I mean the S&P 500, we've seen pretty high volatility about 1 month later, right? But what we've seen every single time 12 months later is that the market ended up even higher. So of course, this week it's going to be a volatile one, especially with the triple witching events that we have on Friday. But what I would expect from investors, even on a global basis, is that any dip in the short term is going to be bought because people are, playing the momentum play. And in the long term, there aren't any major headwinds, especially with AI capex at all-time highs.
Yeah, that's a good summary of what's going on. Momentum seems to be driving a lot of story, and we've got record high week after week. And that seems to be continuing, at least going by what we've been seeing. Walk us through what you're seeing when it comes to the momentum. What's driving this momentum?
Obviously, the tech is sort of the corner of the market everybody keeps talking about. And I like to think of it as not just one corner of the market. It's essentially the cornerstone of the market, right? When you think about big tech, it essentially makes up a third of the S&P 500, obviously a much higher portion of the Nasdaq 100. And when we look at names that are part, the hyperscalers that we all speak about, right? They're essentially growing earnings quarter after quarter. And it's not just concentrated in tech because they make the headlines, but essentially 80% of all of the S&P 500 constituents beat Q2 earnings expectations. So we have this really interesting scenario where stocks are close to all-time highs. Major indices are at all-time highs. Home prices in the U.S., they're at all-time highs. Bitcoin and gold, those are at all-time highs. Money supply, all-time high. National debt, the same story there. So the Fed, with the idea of them cutting interest rates this week, is going to be very interesting because obviously they have this, they're stuck between a rock and a hard place where inflation is still persistent, but we're obviously seeing cracks in the labor market. But obviously I don't see any, major volatility until the announcement itself. Afterwards, I think we're going to see the momentum traders sort of, maybe pull back a little bit right after the announcement, but I do expect everybody to buy right back in as soon as the markets tend to, as they settle down a bit after the announcement.
Yeah, Oktay, to your point, it has been driven a lot by some of the big tech names. Are we also seeing that momentum broaden out to the wider S&P 500?
Yes, we have. I mean, if you look at, let's look at the performance year to date of the Nasdaq 100, right? We're roughly at about, I think it was 12-13%. It's the same for the S&P 500, and it's the same for the Magnificent Seven, right? So I know, once again, tech names, they make all the headlines, but the growth story this year has been very broad-based in the U.S. market. If you look at every single sector, there's not a single one that's in the red, right? So whether it's real estate, whether it's consumer staples, whether it's consumer discretionary, it's a very broad-based growth story. And obviously the tariff narrative has been what's driven the markets down up until April. But this, 5-month rally since has been very broad. And what earnings have told us until now is that tariffs, at least initially, aren't taking or aren't imposing a big enough of a hit as, a lot of economists or a lot of, predictors in the market essentially had expected.
Yeah, so that's a very good point. How should investors be thinking about the tariffs? How much of that has been priced in when you think about the earnings, especially on the retail side? At some point, you might be looking at higher costs for businesses.
Yeah, I mean, the key story here is that obviously input costs are, expected to increase. But what we've seen, especially from, biggest companies in the world, is that obviously half of their profits are not just generated in the U.S., but they're also generated abroad. So what they've been able to do is they've basically been able to pass on those higher input costs to the to the consumer. When you have a labor market that's still relatively strong and a consumer that's relatively strong, you can do that. But as these labor market cracks start to show, I think what we'll see is slightly a more, I don't want to say gloomy picture, but a more realistic one where, we're sort of going to get back to a more uniform picture, and we're going to see this decoupling of the stock market and Main Street sort of, grow a little bit closer, because the broad-based growth up until now, or I should say at least since April, has been very strong. But I think it's one of the most hated rallies that we've seen in recent years. And everybody is saying that the S&P 500, obviously, if you look at fundamentals, it does seem stretched, right? Price to book sales, they price to book numbers, they seem very stretched. On a PE ratio basis, we see the same story. And over time, as long as the AI CapEx story, as I alluded to earlier, as long as that narrative continues to grow, I keep saying the music doesn't stop until the AI CapEx story stops. So for the foreseeable future, even with whatever happens with FOMC, I do think we're in for the momentum plays to still be in play for the foreseeable future. And by that, I mean the next 12 months.
All right. September, typically a historically bad month for markets, but we do have some data to look out for in the coming week. We've got retail sales, not just in the US, but also from China, and in China, industrial production numbers as well. Walk us through what you're looking out for when it comes to the data points in the coming days.
I mean, if we were to just look back at, what the latest numbers told us, right? It's been a very broad-based slowdown. So obviously with industrial output growth slowing, retail sales growth slowing to the weakest levels this year, honestly, and unemployment growing as well. So part of the story is cyclical, but it's also structural. So one of the things that we have to be very aware of is Beijing's sort of crackdown on overcapacity. And obviously the U.S. tariff narrative, I don't really have to, get into that. But they're essentially weighing in on factories. So for investors, what that does is it reinforces this fragile recovery theme, right? So looking ahead, what markets are expecting is targeted policy tweaks. So that's in the form of subsidies, that's in the form of consumer incentives. But I don't think we're going to see the kind of massive stimulus that we saw in the past cycles. If we're looking at U.S.-China trade, right? We're very close to 19-year lows, right? As Chinese imports to the U.S. are drying up. So eventually, I think this is going to cause inflation to American consumers as these supply chains can't be supplanted. So it's going to be very interesting to see those key data points come out this week. And I think ultimately for the end investor, it's a very interesting story, right? I think we're all seeing with not just happening what we're seeing with not just what's happening in the US, but also in Europe and China, right? So all of these markets are absolutely rallying. And I think the story there is that when you have poor returns from things like bank deposits and bonds and obviously the property market in China, the stock market has essentially become sort of one of the few places where people can still feel relatively safer putting their money or investing their money and ultimately being confident that it's not going to melt away. So yeah, I'm very interested to see what the latest numbers show us, but I don't expect anything to blow us out of the water, because especially in the second half of the year, I don't see too many tailwinds to tell a story that's been very different to what's been to what we've seen the last few months.
All right, will the momentum continue as we look towards the FOMC rate decision as well as the data points in the coming days? We've been in conversation with Oktay Kavrak. He's the Director of Communications and Strategy at Leverage Shares. Oktay, thank you so much for your time and insights this morning.
Thank you for having me.
All right, great having you on. We'll talk to you again soon. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.